Hey everybody, DayTraderRockStar here, and this video here is going to be a video to help new subscribers, new members of DayTradingRadio get familiar with the charting that I do live on the air each day. I got a lot of questions talking about what indicators do I have, where do I find these? So I wanted to make a kind of an introductory video to put out on the forum to kind of introduce you to exactly what the questions are coming out to be. You know, what indicators do I put on my charts? What are they used for? And some other things that go along with it. So basically an introductory video for new subscribers. Hope you enjoy this and hope it helps you out. If you have any questions, you could always reach me at ironaction@yahoo.com or just leave a note in this forum and I could get back to you. All right. When you're watching the show and I'm trading with you, you're going to see typically three different type of charts. My main chart here is what we call the Medved Trader chart. It's a chart program, great chart program. I've been using it for over, I think probably over a long time, 20 years maybe, who knows. But recently, it's been they were bought out. Medved Quote Tracker was bought out by Ameritrade, and then Jerry Medved went on to develop his new trading, platform, this new charting platform, and this is called Medved Trader. So I'll leave you the link up there. I'd love it. It's very reasonable. You have to work your way through on attaching your quote feed to it and stuff. That's of course another video out there if you need help on that. But basically, this is what you're going to be seeing during the day. Now, I have my screen colored black. I'm used to that. You could always adjust your stream. You could have a white background. You could have a pink background. It doesn't matter. But that's the way I typically use mine, with the red and green candles and just kind of that black and very sharp-looking colors on there. And I could zoom in. I'm very familiar with this charting platform, so I use it all the time. And this is what you see mostly on the day. And typically we're covering the ES on this. The ES are the NQs, which are the future contracts of the index of the S&P 500. This is the E-mini 500 contract, the futures contract. And this is where we, analyze the market. Really, it's our fastest time frame that we use, the 1 minute time frame. And we really just break down the market. I break down the market, discussing trading opportunities and where we're going to go with that. And on this chart is where we have all the good stuff. Now, DayTradingRadio, again, not to go into a big history here, has been on the air for over 10 years. I've been trading since mid-90s. We'll call it the mid-90s, 95, 96, full-time trader. And over the years, I've developed a methodology we now call high-probability setups. And it's just, as you do, as you have a lot of experience, a lot of basically experience, you learn. The most thing that I learned is what doesn't work. So I've kind of eliminated a lot of things, and I've only kept the highest probability trade setups that I pass on and teach and point out, and basically trade myself. I mean, I'm a good example of just what I teach, is because I know there's certain setups in the market that give us a great probability of getting a move in our direction that we're trading, and that's what we need. We need movement on a chart. We need to take action. We need to push a button, and we need to see that stock move in the direction of our trades, be it short or long. All right, and I'm able to identify those by the indicators and just by overall experience. So all these indicators are over years and years of study. I could put the MACD up here. I could put a lot of Bollinger Bands. I could put a lot of different things on here. But I preferred strictly a stochastic trader, a chart trader, a divergence trader, and some of the other key indicators that I'll talk about are great, just to kind of give us indications of trend, how strong the trend is, and the areas of resistance and support where we add everything together. I always say the high probability setups are really based off of 5 different indicators, and those 5 indicators I tend to put on the chart, and when they all line up is when we get a trading opportunity, and that's what we trade. So we'll start off just looking at this ES chart, and as you can see, that there is a bunch of lines on here. So I want to actually go back and talk about. Let's go back here. All right. How to set up your chart looking like mine, and indicators. All right, so we have moving averages. This is a 20, 50, and 200 exponential moving average. All right, these are your, let me see if I can bring that up on the screen, not to jump back and forth. Shouldn't be that hard. These are your red. The red is always my 200 period moving average. Green and blue lines. Now they're very squiggly. They usually, very close. Again, moving averages, any type of indicator that kind of track the time frame usually have a period that's associated with it. In this case, a 20 period or a 50 period or a 200 period, or you have a stochastic 9, 14, 40, or 60. All those numbers represent a period of looking back and gathering that data and plotting that indicator on the chart. But it's going back 9 periods, or it's going back 20 periods or 50 periods. So that's how that moving average, how you come across those numbers. So we have the 20 period moving average, which is the fastest. It has the closest relationship to the price. That's the green light. And when we have a very strong trend, lots of times that price will hold under the 20 period moving average. And that's, that'll tell you some information right there. Today was a great example. If you happen to be, just today's chart, we were down about 400 points on the S&P, and we sold off pretty hard. And you can see that green line really was the, when you're starting to hold that 20 period moving average, that is a very strong trending market, in this case trending down. And then we have our 50 period moving average above that, and that's our second level, that we watch. And then we have the 200 period moving average. And of course, this is a great example because, as you see, we hit the 20, then we bounced and hit the 50 and pulled back. And once we finally got through that, we came up to the 200 and hit it basically to the penny. And from that point on, that the market again. This is where we are right now, right on that 200 period moving average. So the 20, 50, 200, understanding trends, understanding how that plays in. Also very easy to measure the trend by seeing where your 20 period, your 50 period, and your 200 period moving averages are. If you have the faster one above the other two, then the price will be heading higher. If the fast one is underneath the 50 and the 200, basically the trend is down. Again, you could basically look at the direction of the moving averages to see where the pressure of the market is. So that fast one, the green one, that's our more volatile one. The 40 period is a little less. Well, actually, the 50 period is a little less volatile, and the 200 is really the big boy, and we use that a lot also. So that's your moving averages. Automatically, most charts will have those. Next up on the screen here, we have the VWAP. All right, you can see the VWAP is this salmon-colored line, and as the market just opened up here, it started fresh here, and that's the one thing that the VWAP will do. It will start at the beginning of the day, a whole new session. And what it is, it's the ratio of the value traded to the total volume traded over a particular time frame, or it measures the average price at which a stock or an index has been trading over that time frame. So it's similar to a moving average, but basically takes in volume and price, and it's really it takes in the volume a lot. So if there's a lot of volume at the price at a certain point, it's going to be different from the moving average, which is not calculating the price and the volume and all the calculations that are going through on this. It's an excellent. I haven't used it probably less than 3 years now, and I really enjoy it. I like to trade it as an indicator in a way of just as a resistance support indicator, a target indicator. It usually gets tagged a couple of times when we're trading underneath it. We tend to bounce off it a lot. And again, average volume, average share price being traded. A lot of people use the VWAP. I don't know if I use it like this, but I do use it as a target. We talked about the theory of if you buy it under the VWAP, the price is going to push up to the VWAP, and if you short it away from the VWAP, the price eventually comes back down to the VWAP, because this is the average volume. And remember, it's a volume-weighted average. That's what the VWAP stands for. And it's calculated by adding up the dollar traded for every transaction, price multiplied by the number of shares traded, and then dividing it by the total shares for that day. And again, it starts the beginning of the day and closes at the end of the day, and it's all fresh, fresh data that comes in at each day. And as you can see right now, there's not much volume going on, so the VWAP and everything is here all lined up here. But earlier today, when we had that big sell-off, you could see that the VWAP was way underneath. We were trading way away from that, and we're just selling off. But the average volume for price up here, we never came up here and tagged that. But we like to use it as the price tags it. So I use it as an indicator. If it lines up with a divergence or it lines up with a trend line, there's another indicator. Or we always looking for multiple indicators to line up together. 3 to 5 indicators make it an HPS setup. But this is a newer indicator I have on my charts. I like it. It's actually, I was reading some of the history on it. It was first time used was in 1984. So it's actually a kind of a newer indicator in the big picture. Pivot points here. The next one, P as the main pivot, resistance 1, resistance 2, resistance 3, support 1, support 2, support 3. These are, again, use these as support and resistance level, and these are also calculated by previous day's data. So the previous, you take the opening and closing prices, the highs and lows, and you put it in a formula, and it'll spit out the pivot for the next day, basically. And again, those are basically used the same way as support and resistance. Let me bring this up on the screen here. And you can see the pivot today is a little bit higher. And the general rule is that the price is trading underneath the pivot, it's bearish. If it's trading above the pivot, the main pivot, that's the P, if it's above it, then it's bullish. And that's kind of an up, and again, I'd like to see that trade above the pivot, hold above the pivot. Lots of times you could actually look back at some charts and see that pivot, if you could remember where that pivot is, and you could actually see resistance 1, resistance 2. The pivot is a green line, or actually, where is it? Sometimes it's harder to see, but when you look at that bird's eye view, you could see support going up higher and higher. Now support's coming down, and you have to think that the pivots are also, look at all those things all over here. There's a lot of information on this chart. You don't want to get too crowded. But a simple one, support, resistance, use it the same way as you would use the VWAP. If something lines up together, the VWAP and the pivot area come into play, or the 200 period moving average comes down to a support 1 resistance area, or a support or a support area or a resistance area. You would add those up as a higher probability trade. It's not my favorite. I put it on there. It's easy enough to calculate. Most platforms could calculate the pivot. I don't find it that. I don't trade off the pivots. Like every time the pivot, we get up to the pivot area, we could trade the main pivot, the P. That's probably one of the better indicators. I see the S2 here is also green. I have to change that color. Next up, the horizontal lines I have on. I think these are very important. They're very important on the horizontal lines on the chart. Now, again, the high of the day, the low of the day, very important, very easy, right? You want to know where the high is, where the low is. You would like to know where the previous close is. I mean, the previous close is typically right where that. If you're trading flat on the day, it's probably because you're trading near the previous close. So you have the high, low, previous close. You have the previous high and the previous low. And remember, these levels that you're seeing, the high, the low, previous open, previous close, previous high, previous low. Those are the data that's put into the pivot points, and you spit out the new resistance levels. But personally, I like just the straight up low, high, previous low. Those are important because when we talk about looking at a regular chart, you want to be able to take out a previous high, or in this case, we're making a series of lower lows and lower highs, or higher lows and higher highs. And for that to happen, you have to know where the previous high is, and it's just a simple technique to understand that. Consolidation. Right now, you can see the market is sold off on this church in white. Not that I have pivots on this chart. This is a different chart altogether. You can see I have a nice trend line under here. But I do use it on the futures charts a lot. Let's go to the next one. So that's a horizontal open, close, high of the day, HOD. These are some of the initials you'll see. Low of the day, LOD, previous close, P close, previous low, P low, previous high, P high. And then, of course, volume. Volume is just a standard. Volume is always important. Volume precedes price. Well, probably one of the more important indicators that you could have on your chart. The increase in volume is very important. Decrease in volume on a pullback. A lot of charts are identified by a lot of chart patterns are identified by their volume. You want to have certain volume coming into a pattern, and then a breakout you want to have increased volume. So volume's always important. I always have it on all of my charts, and you always get to look at if there's news out there. The first thing you'll see is a big spike in volume, and you'll see the price typically move also. But you put the two and two together, the volume is really going to show you the activity. You're going to have most of your volume at the beginning of the day and at the end of the day, unless there's other news that comes out. So that's the volume. That's an easy one. It's right in there. And then we have the stochastics. These are this is the bread and butter. This is the money maker. And I have the fast stochastics, the 9.3 and the 14.3. And I jump back and forth. And what I've done is adapted both of them. When I look for a divergence, I want to see a divergence that qualifies on both the 9.3 and the 14.3. Lots of times we'll get a divergence. Here's a divergence right here, about 315, where we have a high and a lower high. Well, we have it also on the 14.3. A very nice one here. So you have both a divergence on both of those, and the high or low right up against the 200 period moving average. Again, another indicator we use. So we have an indicator, the 200 period moving average. We have a divergence with the stochastics. And actually we had a tradeometer, which was a yellow mark here. So there's a lot of things looking at this. This is why we go to work here and plan out a trade to the downside, because of all these things that are lining up, especially the divergence. The divergence is key there. So that 9.3 divergence, the 14.3, I keep them both on there. I like to watch them both. Sometimes I'll see a divergence in one and not the other. But if I do see them in both, I can get a better feel for it. The 44, I used to use this a lot more with the my triple stochastic flag setup. I like to see this pinned above the 80 line and a rotation down like this. I don't know if there's any good examples of that, because we're selling off today, so we had a lot of bear flags today. And the bear flags, if the 44 and the 60-10 are embedded underneath the 20 line and you have a fast rotation, that this tends to be a breakdown. Also with the stochastics, as you can see, we have a lot of, not just the divergences. Today we actually had a great setup, which is called the coil stochastic channel breakout. So a lot of the HPS playbook plays, which are the high probability trade setups, it's our business plan. You'll see that, this video will be in that section. So if you're looking at those trade alerts, this was, the stochastics have a lot to do with all the trade setups. I like to use stochastics as my foundation. Now the 60-10 is an important one. That's, typically I'm jumping back and forth between the 1 minute on the futures and checking also the 5 minute. I like checking the cash on my 5 minute time, which is the S&P 500. And if I'm going too fast, you'll eventually you'll pick up some of the terminology here. But the futures here, this is a very clean look for my divergences. I'm able to identify the divergences live, see the coils, understand the channels and how they move. And this full stochastics, the 60-10 here, very good. I mean, this actually, we had a divergence right here, and at this point we pointed out the best long of the day, even though the market was a bloodbath. When we see a divergence on the buy side on the 60-10, that represents almost a 5 minute time frame setup, a 5 minute divergence. And if and I double checked that for you, it's also a 1 minute. There was also kind of a 1 minute divergence here too, between this low and this low. So this is a really good zone here. Now you can see we talked about seeing a divergence on the 9.3, but not on the 14.3. And then again, a lot of this information might be a little advanced for you, But this is a textbook setup right here. The 60-10 divergence is really key. Really points out the bottoms in a lot of days. And I jump on this every single time. If you could get a divergence like this on the 60-10 in a downward trend, that is your golden ticket right there. That's what you always want to trade. That's what you come to work for. So keep all these indicators on your thing. Just remember, you don't want to be trading too aggressively. You just want to have those playbook plays come into your lap. If you see one or identify one, then you know what to expect from it. Execute your trade, you take it off, and you wait for the next one. All right. You wait for the divergences. The indicators all lining up. The HPS methodology requires three out of the 5 indicators to line up. And when I say line up, is activate. A divergence or an oversold stochastic plus a trend line or a support level versus a recognizable pattern. The patterns are all important. And again, I know there's a lot to talk about. This is just about the indicators on the screen to get you updated. Just kind of tell you what you're doing. I don't want to make this video too much longer. I will tell you this. It's very important to learn the divergence setups. I have a course on the divergence setup. It's over at theschoolofstock.com. It's everything you want to know about the divergence and how to set up your business around the divergence trade. That's where you get all that information you missed in this introductory video. So go to the School of Stock, and let me bring that up for you right now. All right, so I'm just going to show you the School of Stock fast. It's my only 2 educational program courses that I put out, and I just add to them because I feel like, the trading here is so precise, so the criteria is so strict and so developed over time. It's very easy to keep this organized and put the whole system down into just 2 courses. And I add, if there's any updates, I usually add to the courses. It's the schoolofstock.com. And you'll go to a page there, and I also have a free course there, just an introduction for kids. So there's a series of videos for beginners, students, kids, really some of the basics and stuff. But right down here, I have the Ultimate Divergence course and the HPS methodology course. And the HPS methodology is basically the whole trading package. This is, learning about every pattern, every aspect of trading. The divergence course specializes in our go-to trade. This is, if I could take any trade, this is a trade I would take, and this is what I built my my business around. And again, there's so much in this course. So just check it out if it's something that interests you. It's not that expensive. It's always being updated. It just has a lot of great information on it, on how to trade divergence, every aspect of the divergence, and I answer the questions if anybody has them on there. It's $349, and then of course the HPS thing is all the trading, everything. Again, from everything, philosophy, methodology, goals, getting started, equipment. Just again, go through developing a trading plan, trading basics, trend lines, everything, support and resistance, flags, candlesticks, reversals, everything you need to know. And the important stuff, no wasted, just no wasted information. Remember, I've been doing this over 23 years now. And, I can tell you, a lot of things that work and what don't work. So I want to just, stick to the things that work. And we identify those every single day. So, if you do see me mention that divergence and you have that tradeometer set up, actually the tradeometer's working tonight, overnight. We just actually got a sell signal. Just turned on, it looks like. Anyway, that's it. I hope you enjoyed this video. And I hope it gets you started here at DayTradingRadio.com. If you have any questions, again, you could email me at DTRs@DayTradingRadio.com or ironaction@yahoo.com. And I could try to get back to you on your questions, or just leave them in the forum here. All right.